Sure.
Okay, so good afternoon and a warm welcome to all of you. Thank you for joining us for Finance Conclave 2023. And I'm delighted to welcome you and our esteemed panelists, Mr. Anuranjan Manhot and Mr. Amit Ratanpal and Mr. Bhavya Shah. And we are happy that you were able to find time from your busy schedule and agreed for this conclave. So today we will be deliberating on the theme winning in the mainstream, strategic imperatives for private equity and alternative investments fund in India 2023. So we will be discussing future of alternative investments, private equity, venture capital exits, key trends funding winter, and discussing on the fall of SVP and Credit Suisse, Unicorn, AIF in India, etc. So now I would like to invite our director, Dr. Dipankar Chakravarti, to kindly facilitate our panelist with a green certificate and share a few words. Yes.
I mean, for our guests, this is a small initiative that the Jaipuria group of institutions has taken as a commitment towards sustainability and environment. Is we felicitate whoever is joins us in any kind of forum, in any kind of panel discussions or visits our campus. We felicitate them with a plant which has been planted in your name in a location in Jharkhand. Now, so this is a plan that it also has a a location which is given a certificate number which has been given there, and you can track it as a geolocation certificate, so you can locate your plant and see that how this the plant is growing and how it is happening. So this is a small token of gratitude for for our guests who have come out of that busy schedules and participating for this. So please accept our gratitude, Anuranjan ji. This small token that we have.
Thank you very much.
So there's a plant in your name. There's a certificate. You can always look at that. Amit ji, thank you very much for coming and becoming a part of this important panel discussion. And so please accept our gratitude and accept this small plant that has been planted in your name in Jharkhand. And also Bhavya ji, thank you very much for gracing this occasion today, and welcome you to this panel discussion. And so we also like to express our gratitude to you for coming in the afternoon today and spending some time with us and sharing your thoughts. So please accept our this token of gratitude for this day. So this is what this is the traditional way we try to welcome our guests. So it's good that that we having this session today in the in the afternoon, and the finance club headed by Dr. Amit, and then also supported by Dr. Nupur and Dr. Sudipta. They have really put together a lot of thoughts behind having this relevant panel discussion today, because it's very important to understand that there's a lot that's happening in terms of the ecosystem in which we are trying to live, in terms of the businesses, in terms of the startups, in terms of multiple ways. And when there is so much of a pressure that is coming out in the in the ecosystem, obviously what is necessary is a set of finances that can help them make their businesses grow. And that's where comes in this alternate investment and the private equity on which we are trying to possibly deliberate on. There are also challenges that this brings in. Is we've already been seeing that although there is a lot of funding available today for anybody who wanting to have an idea to be able to crystallize that idea into something else, but then also on the other side we try to look at some of these investment organizations like the SVP or the Credit Suisse, they're going kaput. Actually, they're just vanishing from the market completely. So that means there has to be some kind of a balance and some kind of a due diligence that I'm sure this panel discussion is going to bring together today, and have a conversation, and then to possibly threadbare look at it. Some of our audience are students who are possibly thinking in terms of setting up their businesses. They have their own ideas. They want to get into something there, and possibly they may possibly come back to some of you to look for funding opportunities and see that how can they grow their business in the near future. So possibly this would possibly lead into for them to understand the due diligences that are necessary in terms of setting up their businesses and also have a successful business. So with these words, I don't want to get in between the panel, the expert panel that is here to actually deliberate on this threadbare discussions here. So what once again, it's really a pleasure for us at the Jaipuria Indore campus to welcome Anuranjan ji, to welcome Amit ji, and to welcome Bhavya ji to this panel discussion. And I'm sure the takeaways from this for each one of us is going to be immense as a part of this deliberations. So welcome to this campus. We would possibly also like to see you visiting the campus soon enough, where you can see that what are our students doing, and maybe advise us onto some of these things that we are trying to do as initiative in the area of finance as well as in the area of entrepreneurship and startups and businesses. So welcome here again, and then we'll look forward to a good afternoon's deliberation. So over to you, Amit ji, for maybe taking the proceedings forward.
Thank you, sir. Thank you very much. I'm happy that again I am getting the opportunity to introduce Mr. Anuranjan Manhot ji. And earlier in 2021, we did a webinar on real estate ventures. Mr. Anuranjan Manhot is the founding MD and CEO of Lumos Alternate Investment Advisors Private Limited. And Lumos is a real estate private equity firm focused currently on stressed assets. And before Lumos Alternate, he was MD and CEO of M Plus Capital Advisors Private Limited, where he was responsible for setting up a real estate fund for the Lalbhai Group, which is Arvind Limited. M Plus has successfully invested and exited in the project of some prominent developers in India. Mr. Manhot has wide experience in various cross-functional areas at some leading business conglomerate, including Motilal Oswal, Future Group's real estate focus, $450 million Origin Fund, SL Group, Reliance Industry, and Little and Company. Mr. Manhot is BCom Hons and LLB and CA and CS. Again, I welcome you, sir, on behalf of the Jaipuria Institute of
Thank you very much. Always delighted to talk to you.
Thank you, sir. Thank you. Our next panelist, Mr. Amit Ratan Pal and Mr. Bhavya Shah, are well known in private equity and venture capital area. I am fortunate to have had the opportunity to share teaching and learning platform with both of them during 2010 to 12. Now I will request Dr. Nupur to kindly introduce Mr. Amit Ratan Pal. Dr. Nupur.
Hello, good afternoon. Good afternoon, everybody. Can you hear me?
Yes.
Yeah. Mr. Amit Ratan Pal, thank you so much, sir, for coming for this conclave. Sir is actually a veteran investor and founder and managing director of Blink Invest, which is India's leading venture capital firms with a focus on fintech and edtech. Sir is a chartered accountant and he holds an MBA from Narsi Monji Institute of Management Studies and also a general management program degree from the Harvard Business School. Mr. Ratan Pal has 20 years of experience and in business building, and Sir has also seen key insights into private equity, venture capital, capital markets, investment banking, and asset management. An entrepreneur by heart, he has been the founding member of Kaizen about 10 years ago. And over there, he realized quickly that technology would be a Rubicon moment for education and finance and would help in building a firm that would identify companies to harness the power of technology and revolutionize education and BFSI sectors. Sir has also played pivotal roles at ICICI Bank and Birla Sun Life Group, working with senior management on new business ideas and opportunities. And he has been a significant contributor towards setting up several domestic funds and have invested and managed 300 crores INR across 21 companies, and also seen several PE exits from these successful ventures when they have taken the public route. When not on Zoom calls, Amit sir loves to do kickboxing, do yoga, travel, and is also a Reiki practitioner. So we welcome you, sir.
Thank you very much, Nupur, and thank you, Dr. Amit, and thank you, Dr. Dipankar, for having me, as a part of this wonderful afternoon. So really appreciate it.
Thanks. Now I will request Dr. Sudipta to kindly introduce Mr. Bhavya Shah.
Good afternoon, all of you. Mr. Bhavya Shah is currently the Managing Director, Private Markets at ARC Impact Asset Management. Previous to this, he was associated with many well-known firms like Mirae Asset Capital Markets, SBI Capital Markets, and Kotak Mahindra Capital. Mr. Bhavya did his MBA from Narsi Monji, India, and is an engineering graduate of Mumbai University. Mr. Bhavya Shah is an expert in private equity and venture capital investment. Welcome, Mr. Bhavya Shah.
Thank you, sir, for taking our time, and happy to kind of discuss my thoughts with the entire Jaipuria family. Thank you.
Okay, so now I will request the moderator of the conclave, Dr. Nupur, to take the proceeding forward. Dr. Nupur.
Thank you, Dr. Amit. And without taking much of screen time, just a little short intro about the topic. We know that the Indian economy has remained a beacon of resilience amid the current geopolitical and economic climate. It has curiously bounced back to its pre-pandemic growth trajectory, and we are now very excited about future opportunities after this opening up. Given the substantial contribution of the Indian alternate asset sector to the growth of India as an economic superpower, the purpose of this conclave has been to deliberate the scope of alternative investments, especially in the sectors of private equity, startups, venture capital, real estate, and also a little bit about the new concept of gift city. So the plan is we are going to have about 3-4 main discussion topics covering AIF, alternative investment funds, real estate funds, REITs, also on startups and private equity, and lastly on gift city. So we have our panelists actually having an experience in all these sectors of alternative investments. So I will actually start with the first question, which is on the sub-theme of alternative investment funds. Our esteemed panel, first of all, since we have our students primarily and also some people who have joined from the industry in today's webinar, could you demystify what are these alternative investments and what are AIF funds? As of 2022, there have been about 1,000+ AIF schemes in India. So what exactly are these AIF schemes and what is this AIF Cat 1, Cat 2 and Cat 3? So maybe Anuranjan sir, could you start with this?
So I'll start with this. So basically, AIF is a mechanism which has been created by Securities and Exchange Board of India, SEBI, to provide a platform to people who have a larger risk appetite to invest in products which are by and large not listed. Okay, so it's let's say we'll give you an example. A company which is not listed in the stock exchange want to raise some money, and a person who don't want to really invest in a listed one and want to come much prior to the listing, or who has a very larger appetite, of risk. If these two can club together, then the need of raising of capital can be fulfilled. So SEBI created a mechanism which is regulated, and a regulatory framework is there under category 1, 2, and 3. different types of product and different types of risk perception in all these products. The idea is that HNIs who has a surplus more than 1 crore rupee, they only can invest in these risky products. SEBI categorize these products as a riskier product. And a fund manager pool money from all these HNIs into a fund. So let's say 100 people joining together on 1 crore rupee each, a pool of 100 crore is available. Who will manage these fund which is pooled by? So there are fund managers who take decisions on these on behalf of all these 100 investors. And these investment managers are appointed by all 100 people collectively, and the manager take decisions on behalf of all these 100 people, invest, and then monitor the progress of projects or progress of companies, and then take exit decisions. And once the exit is done, then whatever money is received from exit, whether it is 2 times, 3 times, or maybe sometime loss, it is returned back to all the investors who invested. So 100 investors who invested, they get back money after say 3, 4, 5 years, whatever the duration the fund manager communicated to these people. So SEBI regulate this environment so that mis-selling is not there, corporate governances are taken care of. And what we do is we raised a real estate fund on same parameter. So what we do is we have almost around 80 odd investors from whom we have taken 250 odd crore rupees. On their behalf, what we do is that we are identifying projects, real estate projects only, across Bangalore, Pune, Chennai, Ahmedabad, Mumbai, and so on. If we like project, we invest between say 30 crore, 40 crore, 50 crore in one project. And what we do is that we take care of, we take care of all the principles of investments like diversification, risk management, time diversification also, not single party exposure, the corporate governance practices, etc., etc. Once we invest, we monitor the real estate projects, monitor the projects, the outcome. And then once the project is sold out, or when we think that, it's mature enough for investment to sell off, we sell, we receive money, and then we give back to our original 80 investors. And what happens in between is that how we make money. We charge a small fee, say between 1% to 2%, and then we provide a benchmark. Benchmark makes if investors make more than 10% IRR, about 10% IRR, about 10% annualized return, we get 20% share in the profit. So this is broad, understanding of AIF. AIF has many categories depending on risk and all. Like private equity, what Bhavya and Amit is doing. They do in different kind of products. We do specialization only in real estate. Many people do it, say, early stage, late stage, seed capital. It could be a very sector specific. Maybe somebody is in green energy, somebody is in natural gas, any solar and all. There are multiple people doing multiple types of business, and money is available from all this. People who understand this business, investors who understand those business, they are keen to take our help for further investments, and their risk appetite is good. So they are not happy with 5% return on fixed deposit, 6% deposit on bond, or they are not very comfortable with equity risk of stock market. They don't want to. They want to invest in a very passive way. They want to make big money. They want to come early so that they can be partner of a company's success and all. So people who understand, they take these kind of decisions, and we help them in doing this. So this is the broad framework of AIFs in India. Pretty mature now, pretty regulated, and SEBI is very active now. Every month, SEBI is coming out with new circular tightening regulations on AI, disclosure norms, audit norms, eligibility norms of fund manager. Not anybody can raise money. You have to be qualified enough to get approval from SEBI. It's not, so we approach, we present our case, SEBI approves, and then we do this.
Thank you, sir, for demystifying the basic concept of AIF. And as you rightly said, people who are not interested with paltry returns. But astonishingly, Indians still, invest in low yield FDs, gold, low yield, rental yielding kind of properties. So Amit Ratanpal sir, could you also let our participants know that apart from like private equity, venture capital, what else, and real estate, what else will encompass in this AIF funds?
Yeah. So thank you, Dr. Nupur, for this question. So if you see, the entire investment bracket, which we say, normally people have been used to fixed deposit investments. And then over a period of time, they realize that, I'm not able to beat the inflation, because at least you want your money to grow as per the inflation, because the fixed deposits are lower. That's where more and more people started investing into public markets, which you can invest through the mutual funds or the direct public equity, or even nowadays we have the PMS services. Now, as the inflation grew, as the wealth creation grew, everyone realized it. Let's talk about a private equity or a venture capital market. You can only participate in the growth of the company when they get listed. But today, all of us know there are so many unlisted companies in India, and they're doing fantastically well, ranging from Fab India, which is into clothes, to, it could be Haldiram Group, which is again into, this, and we can name hundreds of such sort of companies, whether it is financial services or education or even, consumer behavior as well. And that's where the people started wondering that how can I participate in the growth when they're early days? That's where, we invested into venture capital. Then good real estate. The emergence of real estate came is that, hey, I want to be part of a larger real estate, in a commercial real estate, when they're building or when they just sort of bought the land and they're building it, but my 50 lakhs or 1 crore is not going to be enough. That's where the fund got created. Then people said that, there's something called hedge funds, wherein you can even arbitrage or you can even de-risk some of the sort of risk, or there are derivatives. That's where the emergence of hedge fund also came in India. Now, all these are the different alternative methods by which one can make investments and give or provide investors a higher return. So if you look at three categories, like in how SEBI is looked at it, if you see, which came in 2012, the regulation, is that AIF1 is mainly for the startup world, where minimum can be 25 lakhs. AIF2 is for private equity real estate funds, and AIF3 is mainly for the hedge funds, which are the alternate asset classes, as a part of the alternate asset classes where they started doing now. Then we have got currency, which again, when people can trade in currency, people can trade in commodity. All this, if you want to participate in a very formal way, where you don't have the expertise, but you want to work with the manager who has got the expertise, then you can participate through AIF3. And this is how the different asset classes sort of emerge in the quest of only focusing on is, hey, how can I get better return or at least beat the inflation or buy a bigger home or whatever the case may be.
Thank you for letting us know what exactly is an AIF 1, 2, and 3. But we all know that fund managers across the world have a quest for alpha. So since we are talking about high risk, we know that risk and return go hand in hand. So what kind of returns actually, these AIF funds are delivering? And do we actually, what is my incentive that I'm taking so much of risk? What has been the consistent alphas maybe develop, given by these AIF funds?
Dr. Nupur, if it's okay, shall I start on this? Because I've been...
Yeah, anybody, Bhavya ji, Anuranjan ji.
Sure, sir, please go ahead. Amit, sir, please go ahead.
Yeah, so it's a very interesting, in 2010, when I was heading ICICI's private equity fund of funds, where we would invest into third-party private equity fund. And that was a time when we had seen almost all the private equity funds in India or the venture capital funds in India. And obviously since then I've been going through, and we had made a deep study across the board, across the globe as well, in some of the developed market as well. Now, if you see, India is still, I would say, early days when it comes for the private equity or the venture capital world. If in fact, I would say the early stage investments, which has really grown, is actually in the last, I would say, 4 to 5 years. If you look at the US market, they have a 20, 30 years history also. So it's, I would say India is still in a very, very early days. Broadly, I would say the private equity space or the venture capital space can be categorized as following. And there are funds who focus on very early deals. And I would call it is more like an angel fund where a founder wants a seed money or maybe a little bit of a demonstration of that particular product is there, which is called angel investors, but it's more like a seed money. Then after that, then the VC money comes in, which is at the time when the product is ready. There is a very early days of traction on revenue, or maybe there's hardly any traction on the revenue. That's a big place where we've been hearing a lot of venture capitalists making investments because they want to exactly get into the company when the founder just got the product right or the GTM or the go-to-market right. Then we have a mid-sized firms which focus on the SME business area, and then we have the large private equity funds which focus on large, big companies. And lastly, but not the least, but we have the pre-IPO funds. So these are the various categories of, I would say, subcategories, how I would look at the VC or the PE worlds have been doing it. And I would say there have been a mixed response depending on a couple of areas. One is obviously the performance of the manager. B is the vintage, right? If you, for whatever reason, invest into the peak cycle of 2021 and 22, which is what we saw in the COVID, and if you have made a couple of mistakes at investing in companies which is at a very higher valuation, your returns will not be good. So the vintage does play a role. And third is what is your focus on, right? Like, for example, if you look at Blink, what we do is we invest only into very, very few companies. Unlike venture capital, they would invest into 20 companies. We'll probably invest into 5 to 6 companies. We work very closely with the companies and are operationally involved in the company to help them to grow the business. So it depends on what type of this, but broadly, if you, I would say that on an average, if I look at an angel investor, the expectation is about 4 to 5x multiple return. And I would definitely say even more. And there are angel investors who have earned as high as 10x and 20x returns as well. Then we have a VC fund. And if you look at Blink Fund 1, we have on an average delivered more than 45% IRR and 5x of multiple return as well. And so in this space, we have seen again funds delivering between 3 to 4x and actually delivering more than 25% IRR as well. The PE fund is where the high vintage plays a very, very important role as compared to the early days, because that's the time when if you invest into a company which is a large relatively company at a higher investments at a higher valuation, it becomes difficult. There we have seen more like a 20 to 22% return. The pre-IPO fund, I would say, is very, very momentum, and it's all dependent on the public market performance. And there the performance has been anywhere between 10 to 15%. Very few funds have actually delivered the high 20s of return. But at least by and large, I would say in each of this category, we will always see a quartile 1 funds, which will be 20, 30% of the market. In general, we have delivered much more than the expected returns. And I think the key part for anyone would be, or including investors who want to invest in the fund, is how to identify the first quartile fund, if not quartile 1, at least the quartile 2, the top funds, because they are the funds who have on an average delivered more than 15% IRR, still beating the inflation, and even sometimes near to and much more than the public market as well. So this, I thought I'll just give you an overview with my history of being in the fund of fund business as well as seeing some of the funds as well.
Thank you, sir. Thank you for actually letting us know the type of returns, right from the angel investing making 5x returns to about, and on average you said about 22% returns. Moving on to actually venture capital, private equity and startups. This is the next section. My first question will be to Mr. Bhavya Shah. And we know that 2022 was a very turbulent year for startups, with more than 20,000 layoffs, several distressed mergers and acquisitions, corporate government issues, and more than 10 deferred IPOs. 2021, 2022, we had seen about 250 plus kind of PE exits which happened. This is as per this Statista report. So what has been now the future of PE and VC in India in these testing times when we are also hearing about funding winter and fall of a lot of banks? What do you say about the future of PE and VC in India?
So in summary, I can just say that we are just in the beginning phase, as everyone in the panelists spoke about. We are in the chapter 2 of our VC ecosystem book, or a private equity ecosystem book, or alternate investment ecosystem book. We are not in the chapter 8 or chapter 10 of that particular book. Yes, there are ups and downs in any business cycle, and it is in fact the best time to go and find out some attractive companies to make investments in. And it's always good to be contrarian, but at the same time going with the secular growth in a particular trend. So say, for example, tech adoption in India is at X%, and we expect similar stories which has happened in other Asian countries, like say comparing it with China, South Korea, or maybe in US. So there are cycles, and every business cycle has to be taken more as a investment. Greater companies are built during this attractive times. The founders have clean vision to build a business. He's not running behind raising external capital or just fighting competition, or even incumbents become more like right now, because of fall of banks, we are seeing banks having their attention to protect their own balance sheets and their own other priorities to meet the regulatory capital requirements. But now startups or any other mid-stage firm can focus on building a better, superior customer experience and a superior product to a market, and focus on becoming more cost effective, or how do I put it, better unit economics and profitable, as they were not in the previous cycle. So in summary, these are the times, golden times for us to make investment. And in these times, we are attractively finding opportunities which deserve to make much higher, as Amit sir mentioned, that the vintages become a justifying point for a fund manager's performance in future. And these are the times to make the right decisions for investments and seek the benefit of them in coming years from now.
My next question is also an offshoot of my previous question, again for Bhavya ji. Startups actually, in India raised about 536 around about $1 million, in February 2023. That was the kind of money raised by startups. Whereas by February 2022, if we compare the same amount, was about $4 billion. So is this funding winter real, or is it something which we just heard about Silicon Valley or for the big daddies in the business, or is this funding winter really, in the context of the Indian startups also, is it applicable? Does it have a trickle down effect to the Indian startups as well?
I believe every country is facing the same problem. It is not just India. And there are multiple reasons and data points which I can touch upon. But just to cover up, as we have limited time, with few important data points, we saw $7.5 trillion of capital injection just by Fed in 2 years, like in 2020 and 2021. Now there is an unwinding of almost like 500 billion to 1 trillion is getting unwound. Over and above that, inflationary pressures are coming up. So there is double whammy effect of liquidity in the ecosystem. So as interest rates increase, debt products become more attractive than equity capital markets. Equity risk premium keeps on increasing, and hence we tend to shift our asset allocation. So the crux of any investment is asset allocation. Like if you get your asset allocation right, 80% of your returns are right in that particular cycle or a vintage. You have to be, as a fund manager, agile enough to take your decisions depending on the market cycle. You cannot be having a love for one particular thing. It is, you may not give a desired risk reward to your LPs or to your investors. So as we see asset allocation becoming even more important by diversifying into more debt side of products. Like say you get 6% return on a AAA paper in US, why not go and invest in that for 2 years? And then move that particular capital to equity whenever the equity market mushrooms from here on. So which is why we are seeing not incremental capital available for investing into VC or private equity side of equity companies. And another good thing is whatever has happened in the previous boom cycle is that good companies have taken a lot of capital injection and are sitting on good amount of cash positions. Like say, to give out few names, like SVB raised $1.5 billion and they're sitting still on $1 billion cash, or Zomato sitting on $1 billion cash. Or many such kind of companies, they have raised decent amount of capital and they are not starved of raising capital right now. So why raise capital when market itself is not in a good shape? And hence good companies are not hitting markets. And the public market sets the tone for private markets. So how we typically look at investment is, if there is any arbitrage between the return potential for a particular investment between a private market versus a public market, we will choose accordingly. Like capital is very much fungible. We can invest through debt, equity, listed, unlisted, real estate, or any other asset classes. But right now we see that listed equities is offering much higher risk reward return. And hence, particularly in US market and US tech is offering even much better returns as compared to any other asset class. And which is why there are companies which are kind of flocking, like getting re-rated very quickly. Like you look at Facebook, maybe in November, it was trading at around $100 of a share. And right now it's almost $200. So such a kind of movement for a $600 billion company is unheard of. And people are just trying to decide between allocation of capital between DM, like developed markets versus emerging markets. I'm a full bullish person for India, but this is what is happening at a global level. And hence, we have to take those cues when we are looking at investing into India. And once we have taken a thought that, see, India is attractive enough, then you need to prove that particular company is going to give a excess alpha over that particular US company or any other investment opportunity. Only then you will be able to invest into that particular company. So these are like the investment considerations which go behind taking an investment. And if the capital is not giving that kind of a return, we tend to compress in this cycle. And hence there is a funding winter. So this is a long answer to your question, but I just thought of explaining it in detail. Thank you.
So that means it is real. It is even for our emerging markets. My next question is actually for all three of you, and I would request your views. So the question is, we know that startup ecosystem also, as Bhavya said, has been a little more qualitative, like 2022 and now 2023 is being remembered as, where the quality of the business becomes more imperative. That's why we are saying winning in the mainstream. And growth at all costs mantra went out of business in 2022. It's more quality. It's not growth out of any cost. So which sectors do you three think that are going to, boom in the coming years?
Sure. No, maybe I'll start, Dr. Nupur, if that's okay with you.
Yes, sir. Sure.
But before I start adding to Bhavya's, this winter piece and a classic example, which I can talk about, and we've been investing only in two sectors, that is EdTech and FinTech. During 21-22, on an average, on a daily basis, in our inbox, we will look at least, or we will receive at least 5 to 6 deals in the education space or EdTech and 5 to 7 deals in the FinTech space. I would say in the last 60 days, the number of deals may not be even one per day. So just think about the inflow of the deals also has come down, right? A lot of people who thought I want to become an entrepreneur startup also have reduced. And as Bhavya mentioned, that good companies are waiting and who are not doing good are trying to rectify, because they know that even if they go out in the market, they're not going to get any fund. So it's truly real. That's an interesting example. I thought I'd just share with you. But in terms of sectors, let me put it, we only invest into two sectors, EdTech and FinTech. And yes, many times we look at the sectors can be a fancy sectors for a temporary period, right? Or is it a long sustainable sector? Now EV, because of the clean environment, climate, and EV is becoming a very, very important sector where people are making lots of investments, and anything and around or related to EV is becoming a very, very large opportunity when it comes of battery charging, financing the EV vehicles to everything, because there is a different way to finance as the battery cost is very high. So that is becoming very, very important. But if you look at the education sector or in India, which is where we focus on, I think this particular sector also in the last 10 years have evolved a lot, right? Whether it is in terms of, like if you look at in 2010, 12, 13, how many institutions were there who will say, hey, come to us, you do this particular course, and we will ensure that you get a job. Hardly were available apart from the NIT, which were the aptechs of the world. But today, there would be hundreds of such institutions who will say, you focus on a skill, and if you learn the skill, you will get a job. So there is a lot of changes has happened, and that itself has become a very, very large opportunity. Or for that matter, even if you look at the entire online learning as a concept, or early childhood education, and the preschool, if you look at when we invested in 2012, there were hardly about 2, not even 3 preschool groups in India, and they were very small, and they had no standard curriculum. They had nothing which was standard. But today, if you see, the preschool day care has in the last 10 years really gone and become big and matured. So we believe that a lot of different business models are coming in India, right, which are not only replicating what is happening globally, but also is focusing on what is really the need of the hour. With almost a large population like India, we have seen a lot of startup, how they're reaching to what they call as Bharat, right? Today, it was practically not possible even in tier 8 cities or 10 cities to even learn anything on if they want to go for MBBS or lawyer, because there was no access apart the physical. But because of the online world, they're actually going ahead and learning. So a lot of this accessibility has made a lot of difference. Now, if you look at fintech, that in my view is again, while we see UPI has completely revolutionized the digital world in India, but at the same time, if you talk about lending, if you talk about the asset management or the wealth management, today, I would say if US is 75-80% penetrated, in India, it's not even 15 to 16% penetration. The number of demat account is out of 100 crore population is not beyond 3 crores or maybe 4 crores. So it's a very low penetration. Insurance, like not more than 4 to 5% of the people are insured, whether it's a health, life, or many other form of it. So overall, I would say, obviously it depends on the maturity of the sector, but at least we believe that the edtech and fintech, which is where we are investing, is a very, very large opportunity. And even for next 10 to 15 years, we believe there will be a lot of investment opportunity. But I think what is really going to be important is you don't have to create valuation, you have to create value, focus on the right business metrics, grow the business as if you're going to be there for a long term. That is what I think will be more sustainable rather than anything else.
So yes, EdTech, obviously, I do agree. We all say education is an evergreen sector, and my son is just 6 years old, and as you said, EdTech never goes out of fashion, and he has been going for one of the EdTech courses, especially even at the age of 6, because we feel that something substantiate with supplement school. So rightly, EdTech, FinTech are there. Any other sectors, and EV, as you said, Anuranjan sir and Bhavya ji, which other sectors we actually look forward?
Bhavya?
Yeah. So primarily, I prefer to invest in 3 themes, and we continue to find opportunities in those 3 themes only. So the first one is financial services. India has been always giving a good kind of return ratios on those particular companies, like including lending or fintech, as Amit sir said. And second is consumer-enabled businesses, which are tech-focused. This is second area of interest. And maybe third one is like it is more like a 50% for me right now to invest in healthcare, because we feel that India healthcare story is long overdue to be re-rated from here on. But first 2 themes, I think 90% of my time is sorted, and we tend to focus on these 2 themes and try to find out as many ideas meet as many founders, as many companies, continue to invest across stages, like starting from Series A to pre-IPO, and in fact at crossover situations also. So we intend to in fact go on listed equities also to invest further from here on. So this is a short answer about how India demographic dividend will play out in another 20-25 years.
So
What do you
what
say?
we so what we do is real estate. You know, in real estate, there are many segments, starting from warehousing, hotels, offices. Then you have residential. In residential, there are sub-segments like luxury housing, mid-market, low cost housing projects. Then you have cottage developments, villa developments, holiday homes. Then you have senior citizens homes. Multiple things within real estate, and in that also you have many cities. You have cities like tech cities like Bangalore, Hyderabad, Pune. You have tier 2 cities like Ahmedabad, Jaipur, Indore, or Lucknow or so. So the sector is vast. You just need to filter, and then choose really where you want to do, because the scope in India in real estate sector is going to be huge. It can be a $1 trillion economy by 2030, real estate alone. Okay, so India, people are saying that the economy will be between $7 to $8 trillion, and 12 to 13% will be real estate. So real estate will be playing a major role in Indian economy, and in that multiple segment, multiple ways to make money. How to make money in real estate? One is simple lending to real estate developers. I take money from my investor, give it to a developer, charge 18-20% IRR, give back to investor, and take out my fees. Other ways that I take money from investor, take risk of project. If project goes bad, my money is lost. If project is successful, I make more money. And real estate being an asset which is secured by something which is tangible. That's why it's called real estate. So we do real estate, and in real estate we only focus on mid-market housing. That means where the income segment is between say 50 lakhs to 1.5 crore rupee. That kind of housing population only we monitor. And we are into 2 BHKs and 3 BHK. We don't go in 1 BHK. We don't go in 4 BHKs and luxury projects. So very, very specific thing. Very because these all are specialized subject. You don't a person who is dealing in ultra luxury may not be able to deal with people who have buying ability of only 20 lakhs, 30 lakhs rupees apartment. You may not be a handler, or a person who is selling properties to say 30-40 lakh rupees or a crore rupee person. He may not be able to sell properly to people who are buying properties worth 10 crore, 20 crore or 30 crore rupees kind of thing. So the level of what you say, the customer service, attention, the diligence what you required to deal with these people, these segments is completely different. So summary, focus only on real estate. In real estate also, I think one subject was like income building assets. So a lot of people, what we are doing, they create a property, they build the property, rent it out, and whatever rent is generated, it gets distributed to all investors. So this is also one of the segments which many people are doing. And I say that the sector is huge. Jitna kaam karo, utna kam hai.
Thank you for taking me through the next subsection. My next subsection was about REITs,
Yes.
real estate investment funds. So I was reading about REITs. So do REITs qualify as AIF? Are they AIF?
Yes. So it's a separate segment.
So these REITs are actually, in case they qualify for AIF, so in order to invest in REITs, I would also need a minimum ticket size of about 25 lakhs or 1 CR, or even a small amount, like we have real estate mutual funds also, which takes a very less ticket size. It's for retail people. So how are these REITs different from real estate mutual funds?
So, REITs which are listed in India, their ticket size is as low as 50,000 rupees. So, if you want to trade on the stock market, you can buy today in units, and the minimum ticket size is say 50,000. If you want to sell it tomorrow, you can sell it off. Okay. AIF generally is a non-tradable asset. Okay. There are lock-in periods. You cannot just go and sell it tomorrow. It's an illiquid asset. REIT is, by and large, I'll say, if it is listed, it's a tradable document. It's listed in the recognized stock market, and you can buy, sell as per your convenience. You can hold it for 2 days, you can hold for 2 years, or you can hold for 10 years. Now, what people have done is that the assets which are generating income, like in Indore, if the mall is there, the mall, all tenants in that mall, okay, all the retailers in the mall give rent to the landowner. That landowner could be a one company where one person is shareholder, or it can have a 10,000 people which are part of the REIT. So whatever 10,000 the rent is collected, it gets distributed between all the unit holders. So SEBI has provided a different mechanism. It's a different mechanism other than AIF. Okay. So AIF is a separate category, REIT is a separate category, guidelines are different. And SEBI has prescribed minimum qualification norms to list as a REIT. Not anybody and everybody can list a REIT. There has to be a minimum corpus, there has to be a minimum sponsor, size of sponsor. There has to be minimum experience of the investment manager who is managing that risk, because finally you are dealing with public money. So a lot of care has to be taken while dealing with public money. In fact, AIF is also a public money. It's risky, but again, SEBI take care of the qualifications of investment managers, its background and all. And once SEBI approves, you are allowed to list the REIT. And then, real estate mutual funds, I will say it has not, it's not popular right now in India. Of course, a lot of ancillary things are getting added along with real estate. So companies like listed real estate companies, there are hardly any good real estate companies which are listed in India. But what people have done is that along with the people in core operations in real estate, apart from them, the ancillary activities related to real estate gets added to these, like paints and like construction supply material and something like that, all these companies, and a mutual fund of listed companies there. So real estate mutual funds is of companies which are listed by and large, and AIF is for unlisted. It's not tradable on the stock market. Companies which are not, but they want to raise money. Listing से ही पैसा निकले वैसा कोई compulsion नहीं है. You can raise money from AIF. You don't want to list it, raise money from AIF. So REIT and this a little bit different than AIF and real estate mutual funds. And what was the third one?
REITs and
yeah, who
REITs
are the there are only 3 REITs in India, right?
Yeah. Actually, even the taxation structure of REITs and in the infrastructure, these funds, InvITs, which we call, is quite complicated. And it does not qualify like a normal capital gain tax, the way it is calculated, even when it's calculated for properties. So I think REITs also are in a very nascent stage. And my next question, I was just a little inquisitive. was about this recent norm of debt mutual funds. I know it is a little away from the topic, but debt mutual funds have also lost now the indexation benefits, which was like always, a benefit for people going for debt, that FD se zyada indexation benefit FD mein nahi hai, debt mutual fund mein hai. So obviously debt is better. And that is the reason why they were also investing some of the debt mutual funds, which were focused debt. Also, some of them were junk bond kind of debt. But after this indexation, which has been removed, can be answered by any three of you. Do you think this will see a spurt in the AIF segment after this REITs complicated structure, debt mutual fund, indexation benefits being removed? In fact, a new taxation scheme, which we see is all being pushed towards the new regime. So we are actually moving to a more market-based economy in India. So do you really think this will spurt the growth of AIF?
Yeah. So at least, I think the whole objective, if you see how, from a finance ministry or the government or tax is saying that, first of all, they wanted everything to be on par so that not one asset class is more preferred. And that's what they did, with this. So obviously with that, it is almost now becoming from a taxation perspective in par with what, including the fixed deposits as well. But we believe because of this, what is really going to grow is the bonds and the debentures market. Because earlier what used to happen is, what does all these fixed income companies do? All these fixed income companies, I mean, say the funds would invest into debentures, bonds, including government securities or third party. That's what they would invest. Now, obviously, if you're investing through the mutual fund, you will get this benefit. This also means that now I as a retail investor, which is obviously there's a RBI window where you can participate in government securities directly as well. And you can invest as low as 50,000, actually with 10,000 rupees as well, which was never available to retail because of this tax differentiator, including the bonds and debentures. This will enable more and more retail investor participating directly into the fixed income market. So definitely I believe that, the entire fixed income market expansion moving to more and more retail, which is what we're seeing across the global, is going to happen, and which in turn will also be beneficial to AIF as well, because we'll see more and more funds going there. But would love to have Bhavya's and Anuranjan's views also on this.
I think Amit sir, you covered it well. Nothing much to add from my side.
Yeah, nothing much to add on this. Yeah.
Okay, so we now move to the last segment about gift city. What is this concept of gift city? And we know that Gandhinagar has been declared as a gift city. So what exactly is this concept, and how will it help India to become a financial hub of Asia?
Amit?
Yeah. I can do
Sir,
it.
please go ahead. Yeah.
So if you see why this gift city has come, and if you look at different countries, like if you see in Dubai, there is a DIFC, right, which is focusing on financial hub. For any export services, we have got export zones and SEZ services, and nothing was available for finance in India. And India being one of the, I would say one of the fastest growing economy across the globe, and $10 trillion in the next few years, I think there was very much a need to also create this. That, hey, we are as strong as others, and not only for investing into India, but even global investments can be parked there. What used to happen if let's say 10 years back, the only way if someone would invest into India can definitely invest directly to the US or any of the countries, but most of it been routed through Mauritius because there was a double taxation benefit. Now there are no tax benefits with most of the treaty which was there with most of the countries is not there. So what we have seen, or which even the Indian government has seen, that even if you want to invest into Singapore or a lot of other countries around that, then Singapore has become a very important hub where they will raise funds, where global investors are allowed to invest, and from there they can invest into different parts of the world as well. That's the focus of the gift city, saying that, hey, can I make India as equally as what we have seen in other countries like Dubai and Singapore, which is the closest country for us, as a financial hub. That means that today, if you want to invest in India, there are two options. One is you invest into AIF which are the various governed by SEBI, or create a structure outside India. Could be Mauritius, could be Singapore, could be Dubai, or actually it could be Delaware as well. Rather than that, you still go ahead and create a structure in India, in a gift city which has been designated and has all the sort of availability, in terms of infrastructure, manpower, and the benefit, so that you can actually go ahead and make such create the fund and invest in this. So there are multiple benefits around this, and we have seen many of the large banks, including ICICI, where have started creating this. And the whole idea is that today, I'm sure you would have read in the paper whether our Prime Minister has also announced where instead of dollar being the medium of trading, there are multiple countries where the medium of trading between the two currency would be directly INR. And this is what the idea is, to open up the economy. Idea is to have more and more, different global investors take India as a very, very important financial hub. So that's the larger focus and the importance of creating this gift city. But would love to have other,
Yeah. So, I'll give you a small example of that. Let's say a foreigner who comes to India and technically, I'm just saying that if he's resident and all, 180 days and more, something like that. And if he trades in US stock exchange in US, about the US equity, technically he is liable to pay tax in India because he has traded sitting in India. Okay, because he's now what you can do is that you can trade anywhere of you can trade in any exchange in world, in any stock, but sitting in India in gift city, but you are not liable to pay tax in India because gift city is considered as a territory technically outside India. It's a SEZ, special economic zone type of. It's a designated financial hub. Second thing, let's say if you are doing any transaction with a foreign entity, and foreign entity generally want that the jurisdiction of arbitration, etc., should be should be outside India. It should not be in India. So generally they keep Singapore law will be applicable or Singapore jurisdiction will be there. But why we need to do everything going outside India? You can go to gift city now. Gift city is also being developed as an arbitration hub. So a lot of international arbitrations will be happening now in gift city. So financial transactions, financial intermediation in currency, in derivatives, in banking, anything can be done in India, which may not be taxed in India. So all out means you don't have problems of even like minimum alternate tax and something like that, because you are sitting in India but not paying any tax in India just because you are in gift city. So it's coming up well. Dubai is doing same thing. Singapore was doing same thing, and we are on that line. So it's a great step, but it's coming. A lot of regulations, a lot of AIFs are getting registered. The money which was routed through Mauritius, Singapore, maybe Cayman Islands, and all other tax havens, everything can be plugged in at gift city. That means a person who is investing from London, New York, everything, he can pay directly in gift city, and his money can go back to his account without RBI's interference. So there is completely different, regulators for all these things in gift city.
Yes.
Otherwise, if money comes in India, you have to take all these RBI's things, everything.
That's why we are actually seeing now this India's global bullion exchange also was inaugurated in July in the gift city, as well as there's been talks about BRICS banks actually opening up in gift city. So keeping our fingers crossed, maybe the startups who actually lost money in SVB, maybe they move their dollars to gift city. So keeping all our hopes high and fingers crossed. I actually will have to be cut short this speech or this moderation which is happening, because our inbox is over flooded with questions from our students. And if it's okay, can I take a couple of questions of our students, please?
Please go ahead.
Okay, so we have Rishabh. Rishabh is asking that, good afternoon, sir. Can monetary funding from government help startup in this funding winter? Monetary funding from government to come out of this funding winter. So that's what you
government
mean.
has a startup fund around 15,000 crore rupee. And then they have their agencies like SIDBI and all, which are doing these small investments, of course. But I think the criteria is, sorry.
No, sir. Please go ahead. The role of government is just to create platforms and get them started. Nothing beyond that. Like bringing capital is either from domestic capital, can be foreign capital. Please go ahead, sir. I just thought of putting what government has to do.
So, Bhavya, you mean to say that government is there as a support, not obviously
Supporter.
for funding for startups, right?
So government and regulators will set up the framework for the ecosystem to thrive and grow. Beyond that, the role of government is not to provide capital. Like we are not in a socialist economy. We are more capitalist economy as much as possible. And capital has to flow if the returns are deserved by that particular investment class. So government cannot be taking those initiatives. Although government has supported a couple of organizations, as was mentioned, like SIDBI or NABARD, or even public sector banks are also participating in Indian startup ecosystem by becoming LPs to a couple of funds, or even LIC. So these are some of the large pockets of government which are supporting startup ecosystem to whatever extent possible. But most of the capital has to come from, see, India is like, let us do a dissection of India. India is more better in terms of cost structures. So employment cost is much lower. So every economy has their own strength and we have to play by our strengths. Capital is not our strength. Capital is usually imported into India. And hence we feel that FDI capital or DI capital, which has become another brute force right now for supporting Indian ecosystem, both listed and unlisted. We feel that capital has to come from those pockets, not from government side.
Thank you, Bhavya. Thank you. So, Rishabh, the government is a supporter, okay? Not going to fund the startups to come out of the funding winter. Rishi actually has a question. Sir, REITs is an attempt of real estate companies to diversify its capital investments other than debt funds. So, Rishi, this is your question, that real estate companies wants to diversify apart from debt funds. So I presume his question is actually about the composition. What all will qualify as assets under REITs?
So any asset which is yielding a income, regular income. It could be hospital, it could be schools, it could be malls, it could be your commercial office space, it could be anything. What investors generally look is that what is the quality of earning? That means what is the consistency in which money is coming back to investor as a regular income. And based on that, the funding is available and the valuations are done. So better consistency, better tenant profile, assuming that you have a bank which is there in your property, which is SBI. Okay, so you know that the rent from SBI will be coming regularly. Or if you had a Yes Bank in your property, probably your valuation will go down. So depending on what kind of profile, etc., you have. And that's why that's how you can list it. You can think about listing. But again, there are multiple criteria of listing regarding the size of the REIT and all. In India, only 3 REITs are there, and the size is more than 5,000 crore rupee per REIT. So in that way, if you have to, gather many assets to make sure that, your REIT is visible.
Thank you. Thank you for your answer, sir. One of our senior faculties want to know that what are the best or perfect instruments, which is a dream of PE investor?
Bhavya, you want to take this or shall I take it?
Sir, please go ahead. Yeah, Amit sir, please go.
Okay. See, I think instrument is just a medium of investing, and let's look at why and what we do. If we are investing into pure equity as an instrument, obviously we have this voting rights benefit. But what would happen if there is a difference in the way I would look at the valuation of the company as compared to the founders, right? So many times the founders say, hey, you know what? I'm going to achieve a hypothetically 80 crores of revenue by 23-24, and we believe that he's going to achieve 50 crores of revenue. And that's where the valuation differences may come. Then at that point of time, rather than investing in a straight equity, we say, why don't we invest into a CCPS, which is your compulsory convertible preference shares, or we invest into CCDS, which is your compulsory convertible debentures. Based on the multiple and the revenue, your valuation will get determined. So I would say that instruments are being used for a VCOP world to facilitate ease of doing the transaction and also meeting the end objective. And most of the time, the end objective is either the valuation or do this particular instrument give me a better voting right. So for example, if you're only owning a CCPS structure, but not owning equity, technically you are, or a CCDS, technically you are not a shareholder and your approval is not required in a EGM. So what many times we do is we still go ahead and own one equity share so that we become truly a shareholder in that private limited company. And because of that, we get P&L balance sheet, as well as we have to, like, they need our voting power on the EGM. So the objective is where we determine the instrument, is how I would look at it, right? So Bhavya, any thoughts on this?
No, sir, you covered it up very precisely. Thank you.
See, for real estate, it's very simple. The valuations, there are hardly, hardly any scope of further improving of valuation over a period of time, So what happens that whatever value we have to derive, we derive it today. Because our project life cycle is, say, of 5 years, 6 years, 7 years, and the exit is also visible. Once the project is complete, you need to move out. So the instrument generally what we use is a very low equity and a very, very high on convertible debentures, non-convertible debentures, NCDs. So as soon as the cash is generated in the SPVs, the instruments get ready, and whatever premium somebody has to pay, it can be paid on buyback of those equity. So very, very simple structure in real estate. And in startups and in private equity, these becomes complicated because, first round, second round, third round, and, valuations are depending on how the next subsequent round is getting valued. So little bit complicated. We have a very simple life in that.
Thank you. I'll take this as another question from a faculty member that I think for Amit sir, Bhavya ji, maybe you could answer this. What do the first 30 days look like after a PE deal closes? We want to know your experience.
Bhavya, you want to start this, maybe?
Yeah, maybe I'll start off with a fun point rather than going into the hard part of it. So first is that you go for a hard party, chill out with the founders or with the investors who you have co-invested with, because that sets the tone for your next inning. Like, we want to be a partner to that particular company for another 4 to 5 years minimum. And if time permits, we extend our investment period. So It is more a social bonding which we want to kind of create with the founders, which we have already created before our investment into a particular company. But this is more critical to show a sense of more a familyness with that particular company. So number one thing which we have typically seen is that if the company is at different stages, we have different kind of objectives to meet. So if the company is at an early stage, we tend to kind of set out certain ground rules, like say, this is how your MIS should look like. This is how your pitch should be coming out in your follow-on rounds, or these are the hirings which you need to make for reaching to a next milestone. So those are the kind of like how a president gets elected and his 100th day gets measured. We tend to kind of set up such kind of both quantitative and qualitative milestones for a particular company. But if the company is closer to an IPO, we just tend to be helping the company with set of certain institutional investors connect, or refining the pitch, or refining the business model which they would have shared with us, and giving our insights about global companies or global comparables which we would have seen in that particular space. So it is very tailor-made for a particular company. There's no single answer to me for me to give it to you for how we take actions day 30 or day 100 or even a year from there. Amit sir, please add. I would have covered very short.
I'll add this.
Yeah.
Real estate actually.
Sorry, Anuranjan. Go ahead.
I'm saying real estate is a little bit different in this. 90% case, as soon as investment is done, on third or fourth day, the body language of real estate developer changes completely. Now he feels that he doesn't need you. Okay. So that becomes a very, very eye-opener for us. It has happened, I will say, almost all our investments. पहले वो सर करके बात करते जब तक पैसा मिलता नहीं है तब तक, और फिर उसके बाद में फोन भी शायद 3-4 दिन बाद में नहीं उठाया. तो ये एक टिपिकल इंडियन माइंडसेट है. People who respect money and they respect their culture, of course, their body language doesn't change, and these are the partners, ideal partners with whom we would like to work. And in fact, we have done deals with such kind of people only. But yes, the first 6-7 days are very, very critical, because once money is out, once money is in their bank, though we may have operational control, all real estate developers, all real estate private equity players face real difficulties after investing. So that's the key fact in India. And that is where we have to start, monitoring those companies in much, much larger detail, depending on what kind of, intensity in the change in body languages. बिल्कुल बदल गया है तो आप पैसा वापस निकालने की शुरुआत कर दो आप, it's like that. और लगता है थोड़ा ठीक है तो फिर धीरे धीरे आप over a period of time you take out.
So it's very interesting for us as a philosophy. We believe the day the founder receives the money is the most important day which starts, and we generally have a very clear understanding what he or she as a founder is going to implement in the first 90 days, and that becomes extremely critical for all of us. But that is obviously before investing the money, so that 90 days is a period which we believe is very, very critical. But as Bhavya rightly mentioned, and it's a combination of what Anuranjan also mentioned, that while we have a party time and in a building relationship with the founders, at the same time we have also seen a big surprise as well. And it's not about changing the body language, but many times what happens is specifically while the DD is happening, the founder always wants everything to be on track, right? Whether it is revenue, whether it is cost, he doesn't want even deviation to happen. And the day it's like a balloon, right? You keep on pumping in air and try to squeeze everything. And the day you get the money, then at times we do also get sometimes the surprises, and it's a very interesting 30 days to play, and it's a little bit of Tom and Jerry play, which at times does happen as well with the founder. So it's very individual to individual driven, but I think it's a very, very critical phase, right? Because now the money's gone, you can't do anything about it, right? Yeah.
Dr.
Thank you.
Nupuр, I would also
Yeah.
like to add some few points. Like you asked some question related to perfect instrument. So I feel like this should be optionally, partially convertible, redeemable, cumulative, preference share, or debenture with performance ratchet. So this kind of combination is not basically available in India, but we are dreaming for that kind of situation, I think.
Yes, sir. Sir, OCPS is one of the instruments usually used by domestic institutional investors or domestic investors, but it is not widely practiced in our ecosystem because most of the capital which we receive is from foreign, and government doesn't allow foreign shareholders to be having OCPS rights, because OCPS rights are much more better, and there are lobbies which are being defending at various levels, both at MCA level and even at Ministry of Finance, but seems to be like a statement for now.
I'll move to the last question of the day. I know I really wish we can discuss this for half an hour more at least, but due to paucity of time and also because of your other commitments, our students want to know what are the skill sets an aspirant who wants to make up a career in alternative investments should have. And what are the career opportunities in alternative investments in India?
Sure. So again, maybe I'll go. So I think the sector, as all of us mentioned, is just opening up and is going to grow multifold. And obviously real estate will have a slightly different, and private equity will have a slightly different. But I think specific skills which are required, I think is I will divide into two parts. One are the hard skills, and the other is the soft skills. And both are equally important. When you talk about the hard skills, it includes, hey, how good you are in financial modeling, how you good are in Excel, and are all the skills required, which are the basic. Are you good in making presentation? Are you good in analyzing the data? Are you really good in linking two things? Because when we look at business models, we have to see the macro trend, and we also have to relate that to what is going to happen in micro as well. So these are the hard skills which has happened. I think from a soft skill, which is equally important, is because when we deal with the founders, and whether you are an analyst or you are a partner, really does not matter, because you will be dealing at both levels. You will be ultimately meeting the founders and their opposite team, and how to get the right data, how to sort of navigate a lot of things around you. You can't keep on with a high end and say, I'm an investor, please give me this, right? Many times the startup founder may say, hey, I don't want to deal with you. So this particular part of soft skills is very important. Of what I would use, the lack of better word, is navigation. And you have to be very sensible and sensitive of what works, what doesn't work, and what are the types of questions to be asked and what are not the questions to be asked. So mindfulness and awareness when dealing with the founders or the team, I think also plays a very, very important role.
Thank you, sir. Thank you. So yes, career opportunities. We have been seeing a lot of alternative investment companies are actually coming in for hiring MBA graduates. So yes, the sky is the limit, and we all know the sector is actually opening up, and we also saw which sectors are going to boom, as they said about edtech, fintech, EV. Real estates. So there's a lot of food for thought and a lot of preparation on your part, students. And we have been having our student who has been sitting over here writing notes and has been meticulously trying to write a summary of the entire discussion. I'll hand on the baton to my student Sanchit, who will just take us through just for 2-3 minutes on the summary of this entire talk.